I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. For the second week in a row, the stock market moved down in a big way, but stocks didn't melt down alone. While the 2-week drop in the S&P 500 was over 10% to the lows, which was huge, the crypto market went into full implosion mode. That fantasy land is now a smoldering mess. It's bringing reality to an asset sector made up of contrived speculative trading vehicles. After Luna collapsed last month, the sector already was brutalized. This week, giant lender Celsius froze withdrawals to stop what was a virtual bank run. And now questions are around if their private lenders are going to pony up more funds or it will be liquidated. This is reverberating through the crypto sector. Bitcoin, which was already crushed, fell 30% this week. You probably saw our videos on Bitcoin when it was near 50,000, that our target was 19,000. Now we've lowered that down to about 12,000. And Katie's going to show you some of that analysis coming forward. Relative to other markets, the crypto market is minuscule. So you can't say it's going to greatly affect other markets, but still, it shows a sentiment change and the obvious symptoms of the bubble blown up that the government and the Fed created and are now popping. Other big news, of course, was the Fed as they raised interest rates 75 basis points, which was expected. And they're acting under the cover of a strong economy, which, they're saying is true, but you can't believe anything they say. But it does give them the ability to raise rates fast, and they're really never right. They're still quoting, the committee seeks to achieve maximum employment and inflation around 2% in the longer term. How'd they do hitting that last time? Aiming at 2% when it was 1.7%? That wasn't okay. Now it's over 8% based on their just feckless actions. They're now targeting 3.5% rates towards the end of 22. And of course, they're trying to do that. They want to show you this forward guidance and jawbone. So then maybe the markets will all price that in. Stocks did tick up after that news of the announcement, and a little bit of a relief rally that it was finally behind them, but there was huge volatility on that day on Tuesday. On Wednesday as that news came out. And then while you were sleeping on Thursday morning, the S&P 500 fell off over 100 points, and it really couldn't get up on that day, finishing down over 120 points in what was really a brutal day for the stock market. The big news that really hurt equities on Thursday and why they fell so hard overnight was the Swiss National Bank, as they raised rates for the first time since 2007. As their inflation closes in on 3%, well, that's a lot for them. And to give you an idea, their interest rates are still at a minus 25 basis points. So, as they say, this is just the first step, and the Eurozone is later in this cycle of raising interest rates, and it shows that the inflation fight is just starting everywhere else. And the dollar on that news fell off pretty sharply. And we're going to make a big call here saying that we think the dollar just peaked, and that all that money running into the dollar and out of these other currencies I think it's going to start running the other way. We're looking for potential upside in the euro, the pound, and gold and silver. We've been talking about the metals, that there really were a second half story. We've been saying that all the way from the very beginning of the year, and our analysis says that that is about to start soon. So we're looking for a much more favorable period for the metals coming up, really past the August 1st date is what our analysis shows. So keep that in mind. Keep watching our analysis, and you will see us bringing what I think will be some bullish analysis on the metals going forward. Not quite yet, but watch for that. Here it is Friday morning, and what I'm telling you right now about the markets is really so far because I'm presently in an indie hotel on the way on some travels up to Chicago. So this is really being recorded early in the day on Friday, earlier than we normally do. But of course, with a week like we had in here, I did want to make sure that we got a video out today, even though I was traveling. So for the week so far, stocks, well, the major index is down in the area of 5 to 6%. I mean, they've been crushed for 2 weeks here, and we're getting kind of a small uptick here on Friday in the morning, and they have not been able to hold these upticks. So, everything is in suspicion here. Bond market 30s down about a point on the week. They've recovered quite a bit from their lows. They were much worse. The 10-year yields up about 6 basis points at 3.21. The high was 3.48. So they've come off of their highs, the yields, and we were looking for a short-term bounce in the bond market here, and that's what we're getting in what is not a great overall picture. The gold market down about $22. It's $55 off of its lows, so it had a very good bounce. There is very good support, it appears, in that area near the $1,800 area. And the silver market down small. It is $1 off of its lows, and as we said, that bottom is coming soon, and that is in alignment with what we think is a peaking in the U.S. dollar. The dollar small gains for the week. It reversed from a very key level. And if you look at our dollar charts, you will see that the dollar looks like that was a real important spot to stop. And I think that we're going to keep our eye on that and these other currencies, because there could be some very good trades in there, and especially also in these metals if this dollar is peaking, as we are suspicious of. Oil market down about $6, and we think that is peaking also, though basically we do see a range from now into early August of 123 on the upside to about 105 on the downside. So I wouldn't be surprised to see that 105 number pretty soon in the light crude market. Coming up, Arvie's going to preview a member video, short-term swing trade setups, looking at Alcoa and really doing a great job of teaching you how to raise your odds of success as you enter into a swing trade. Katie is going to share multiple time frame analysis on that Bitcoin market, and I think you're going to find that fascinating. I've shown a lot on the Bitcoin now in Future Speak. Arvie's picked that up, and now Katie's going to look at that based on our cycle low timing tracker, which is a very important tool. And then Matt's going to preview our level 1 memberships. And this is, if you're an index trader, this is just fantastic information. So it's our index analysis and more for almost no money. So you really want to watch that preview coming up on level 1 memberships. And I'm going to take you through the 1 to 3 month view, looking at the S&P 500 and the NASDAQs, SPX, and NDX. And I know you're all chomping at the bit to see that. Don't scroll forward. We've got so much here to show you, and make sure that if you do and you want to see what's going on in the stock market, come back and look at these other great things that Arvie and Katie and Matt are going to be sharing with you. I want you to remember to go to the askSlim website and explore. Look around there and subscribe and share the things that we put out, and make sure you follow us. If you're brand new, you can become a free member and you get notified when we put up this show and some other things. On YouTube, do subscribe to our channel. Make sure that you give us that thumbs up and click a notification bell if you want to be notified when we put videos up on YouTube. Twitter, follow us at askSlim. And any questions that you might have on our memberships, our huge offerings of education and analysis, do write to Matt at askSlim.com. All right. This is a preview of a member video. RV does this every other week where he brings short-term swing trade planning, teaching you just a lot about how to improve your entries in the market using this very key style of analysis. And he does a lot about teaching you this analysis and teaching you how to find the advantageous entry zones and how to be able to target. So this is absolutely great stuff. So show them what you got, RV.
So this is Alcoa, and what we've done here is we've overlaid the DBB, which is the base metals ETF, in blue, and we have the Alcoa cycle in black. The DBB does run a very high correlation with that of Alcoa, so we do always want to understand those money flows. And what's going on here is that Alcoa is in a corrective period and in the late stages of a corrective period, which is a period of heightened downside risk. You can see the modest rally here failed quickly and turned right back down here in Alcoa. Our next key low is due 523.274, and looking for a move down to look at this key weekly cycle low here at 43.26, and that's the overall target for this downside move here in AA. So this is the daily cycle analysis in Alcoa. What we have here is a dominant daily cycle broken up into minor halves. And we have the dominant cycle as having already turned down since we have violated this key daily cycle low at 53.34. And we've also violated this key minor low right here at 60.64, which says that this dominant cycle is now pushing down and this minor cycle is pushing down. So when you have that kind of case, if you were to get a rally, you would not look for it to make a whole lot of progress and in all likelihood form a bear flag in the context of a negative slim ribbon and then look for this to turn down. Note this overall PO here is also red because we have a bearish ribbon. So if we were to get a bear flag, we would look for the PO to get a push back up into this overbought region and then look for this to turn down, give a bearish signal, and then look for follow through back down. Very similar to what happened right here. We had a bearish ribbon and a bearish PO, got the rally, formed a bear flag, got the bearish signal right here, and then you can see the sell-off back down. So that's really what we'll be watching for in Alcoa. And we will look for that key bottom to form possibly in either this cycle right here, or it could end up pushing out into this next cycle. We'll have to see how it trades off of this next key short-term timing, and we'll see where we're at in the S&P 500 here as well. Some of the evidence right now is favoring one more hit back down, and that's why we're looking at this on the short side.
All right, that was super. Just great lessons in there. Thanks, Ari. This is multiple time frame analysis. Our work is made up of looking at different time frames because important messaging comes from each of those time frames, with our momentum analysis also, and our projection analysis that we do. And Katie brings it all together right here, referencing our cycle low timing tracker, and you'll learn a lot about that also. And of course, Bitcoin, an important market right now, just because it's in full implosion mode, and I think you'll find this interesting. So take it, Katie.
Hi, I'm Katie with askSlim. Today I'm going to show you how the cycle low timing tracker is showing an opportunity that may be setting up in Bitcoin. This week, Bitcoin had plunged down close to the $20,000 level as liquidity issues in the crypto lending firm Celsius caused worries that the problems could spread to other major crypto players. Now this drop is in line with our analysis, and I'm going to show you that on the charts. First though, I want to show you where Bitcoin is showing up on the cycle low timing tracker. We are finding it in the cycle timing box for both the weekly time frame as well as the daily time frame, which is why we're seeing it in bold. And it's also down here in the in sync box, which tells us that the current daily cycle ends at a period of time that lies within the weekly cycle timing window. Symbols in the in sync box are generally expected to show weakness, possibly even breakdowns, as we head into that intermediate term bottoming period. Now let's take a look at the weekly chart of Bitcoin. This is a 5-year weekly chart, and we have out-of-phase cycles in play here. One is represented by these blue dashed cycle brackets, so let me show you those cycles. The other is a larger, more dominant cycle that is represented by these black solid cycle brackets, and this larger cycle is further divided into minor thirds. Let me show you those cycles. Another thing you'll notice on this chart is these pairs of blue vertical dashed lines here and here. This first pair shows a period of time of a few weeks plus and minus around the ideal bottom of the blue dotted cycle. We are currently in the last week of that cycle timing window, and this is why Bitcoin is showing up on the cycle low timing tracker in the weekly time frame cycle timing box. The second pair of blue vertical dashed lines shows the period of time around the ideal bottom of the more dominant black cycle, which is also nesting with this minor third cycle. So what could happen here is that Bitcoin could get a bounce in the space of these few weeks in between, and then that would set up a short side opportunity for the next move lower into this later timing window, which runs from July 11th to August 19th. Momentum in here is negative, as shown by our proprietary reversal scout. That's this green and purple ribbon on the chart. And so we don't expect any really sizable bounce. And we can go to the daily chart to see what that looks like and what we might be able to expect. This is a 2-year daily chart of Bitcoin. The daily cycle is a major cycle of 60 days, broken up into minor thirds of 20 days each. This green dashed cycle bracket represents the daily cycle in Ethereum. So again, we have 2 pairs of blue vertical dashed lines here and here. This pair, the first pair, shows us the period of time around the ideal bottom for this minor third. We are currently in that time period, and it ends at the end of this week. And that's why Bitcoin is showing up on the cycle low timing tracker in the daily time frame cycle timing box. Now this second later pair shows the period of time around the ideal bottom of this major 60-day cycle, this minor third, and Ethereum cycle as well. So that time period runs from July 6th to July 14th, and that matches up with the beginning of the timing window that I showed you on the weekly chart for the larger, more dominant cycle. This is why Bitcoin is found in the in sync box on the cycle low timing tracker. So what we're looking for in here is for Bitcoin to try to get a bounce as it enters the rising phase of this minor third. As I mentioned earlier, we don't expect any really sizable bounce because momentum on the weekly chart is negative and momentum on the daily chart is negative, as represented by both the reversal scout right here, again, as well as the slim ribbon, which colors the candles green, gray, or red to show those momentum conditions. If Bitcoin were able to get into this resistance zone, from 24,773 to 27,707. That is the area where we would consider it a high probability short side trade as we move down into all these synced cycles, cycle lows in multiple time frames. And we have a target level down here from 18,551 to 14,765. To learn more about cycle analysis, the cycle low timing tracker, and all our tools and services, please visit our website at askSlim.com.
Great, absolutely great work. That cycle low timing tracker is just an important tool that we use, and I think that our members are really loving that. So, of course, that is for level 3 and 4 members. So please do consider becoming a member. Coming up, stock market analysis, and I'm going to show you some great stuff on the S&P 500 and the NASDAQ. But first, Matt is going to introduce you to the level 1 content. What a deal we have on this right now, and you're going to have to write to him to get that special deal. This is for index traders and for longer-term position traders because he's going to show you 2 of our great tools. So show him, Matt.
Okay, as part of our overview of level 1, we're going to take a look at 2 of our key services, the daily snapshot and the Slimulator momentum tracker. First, we'll look at the daily snapshot. The daily snapshot is a comprehensive technical review where we apply the askSlim methodology to the S&P 500, the NASDAQ 100, and the Russell 2000. It is designed for active short-term and intermediate swing traders who look to use the major indexes as a proxy for their trade planning. All right, let's take a look at a recent daily snapshot from today, June 16, 2022. There's 5 sections to the daily snapshot. In this first section, we provide technical summaries for each index, where we cut through the fluff to get to the main stuff that you need, summarizing the current technical conditions, including directional bias, cycle timing, key price levels, and where things could change. Regarding where things could change, we try to keep you on the forefront of what's happening from a technical perspective, especially if you're a short-term trader. As you can tell in the 6/9 edition of the daily snapshot, in the technical summaries, we had indicated that the short-term directional bias was downgraded to bearish. I'm going to pull over a chart on the 2-hour here, which shows our proprietary momentum indicators on there. And you can see here, this is pointing up here, you can see the date, that's 6/9, where the reversal scout shifted to bearish, and then our slim ribbon momentum indicator also went negative on the 9th. That short-term momentum change was a driver in shifting the overall directional bias to negative, which was a good indication of weakness to come, which is what we've seen in a very significant way over the last week. Okay, so that's what we provide in that technical briefing. And on the next section, we include our askSlim charts. On these charts, we provide you with a 2-hour review, and you get to see where our proprietary momentum indicators are changing. You get to see the key technical levels in terms of support and resistance. We have this available on the, again, 2-hour chart, the daily chart, and then also on our weekly chart. Our daily and our weekly charts also include our custom and proprietary cycle analysis, where we provide an indication of where there are upside potential opportunities and where there are downside risks in terms of the timing aspects of our cycle analysis. Okay, this is available in terms of the aspects that I just reviewed on the NASDAQ 100, the Russell 2000 as well. You can see that here with the NASDAQ. We provide the same 2-hour overview, daily chart overview, weekly chart overview. Next section, we apply our analysis for assisting with thinking through the trade planning process for determining upside and downside price projections at multiple time frames, including the short term, the intermediate term, and the longer term. We specify the price projection zones, the dates that they were indicated, what price levels they would need to see to have reevaluations, and we update this information on a daily basis. In the next 2 sections, we have our momentum tracker and charts. This is our technical evidence comparison area. So at a glance, we can get a view of the momentum conditions at multiple time frames between the 3 indexes. And then finally, we offer the cycle analysis table, which details out the 3 aspects of our cycle analysis work in terms of the pattern configuration or pattern structure, the weekly cycle timing, and then the projected dates for the weekly cycle lows or the daily cycle lows. Understanding the momentum condition is a critical variable in trade planning and position management. The Slimulator Momentum Tracker, which is part of our Level 1 service, does just that. It gives you access to our proprietary momentum readings on more than 1,000 stocks and ETFs. You can use our custom algorithms with the Slimulator Momentum Tracker to generate a directional bias and outlook from the momentum conditions of these 3 timeframes, which are weighted to support active investors and longer-term swing traders. You can search and review the momentum conditions of a single symbol of your choice, build your own watch list, or select from one of our pre-installed watch lists, which we have several. You can also sort and find symbols with the most bullish or bearish overall momentum conditions, which then are shown here by the directional bias. You can click on the directional bias and instantly get a view of which symbols are most bearish or most bullish. I'm going to take a look here at AAL, and I'm going to expand the view and look at the chart so I can see a change log of the directional bias. What's interesting is, I'm going to just scroll down here a little bit. This was in November of 2021. You can see that AAL shifted to a mixed condition here, and then we went to a slightly bearish condition. And since then, all of the changes that have occurred in the directional bias have been fluctuating between very bearish, bearish, slightly bearish, back to very bearish. And what's most interesting is you can see here, as even when AAL rallied, our directional bias did not shift to bullish and maintain that more negative reading. And then it shifted back to very bearish here in May, and then we've gone into a steep decline as of late. So it definitely helps to keep you on the right side of the trend, utilizing momentum as that directional bias component. For those of you that are interested in learning more about our Level 1 service or signing up, reach out to Matt at askSlim.com or go to our homepage for special offer opportunities on our Level 1 package. We wish you all the best and great trading.
Great stuff. Do write to Matt at askSlim.com and tell him you're interested in that special on the Level 1 content, and he is going to send you a link. And it's basically, you're going to pay very little. And the 3-month deal is incredible, and you're going to get a real good sense. And if you're an index trader, you can see this is just incredibly important information you'll get daily. All right, this is the stock market analysis, S&P 500, and I'm also going to bring in the NASDAQ also because I think it's important to do that based on this analysis. And there's relief rallies coming. We may be in one right now as here we are recording on Friday, and we've had some very severe drops where just the last 2 weeks the market fell by over 10%, and that is one of the biggest drops we've seen in a long, long time. So generally you get that, you get relief rallies. Where will they go to? And when they fail, how far will they fall? There is so much talk out there that the market is going to make a bottom, and it's, the investors are always sure the market will make a bottom in the long term. You have to just sit through all of these, and the market keeps going up. But there are times when that is very, very difficult to do, as the markets fall 30, 40, 50% in bear markets, and bear markets tend to last on average over a year and fall by over 30%. So they tend to be very difficult to sit through. And it's just this take it for granted attitude that you can sit through these bear markets and they'll just be moving up again and move up to new highs and big recoveries. And we have thought that would be a false assumption for the market over these next months. And maybe well into 2023. So there will be big rallies. They will look good. But what the central banks have to do is a very giant task, because they have gotten themselves in a terrible situation with micromanaging these economies and keeping massive bubbles blowing in assets, and even the earnings levels have been in a massive bubble. And the S&P 500 earnings that all the analysts look at are based on bubbly assumptions. And that's not going to be the case. The earnings recession is going to hit, and the whole concept of that, okay, we're at 17 times forward earnings, and that's the average. Well, that's silly, because in bear markets, I've seen them go to 12 times or worse. So, of course, I've been around 48 years and seen all of the bear markets since 1973. So that's quite a long period of time, would you say? So there are not a lot of people still in the markets that can say that they have been around trading these markets for that period of time. So I feel good about that. So let's take a look here as we look at the S&P 500, and then we'll switch over and also look at the NASDAQ. So here is that S&P 500. And what we're looking at is the whole period from the panic lows all the way over in 2020 over to where we are right now. And what's important to see is that this right over here suggests that this whole thing was this historic everything bubble that's going on that created the Bitcoin and NFT nonsense, the crypto nonsense, and SPACs, and all of those bubbly gambling vehicles that people went into as the valuations got to incredibly high, historic 200% of GDP on the valuation in the stock market. And now over here, as you can see, now labeled as the Great Reset, from the really horrible setup, now the third one in 24 years that the government and the Fed has set up, that now investors have to sit through, and so many will be bloodied or already have during this period. So let's take a look at where we are right now as we're projecting the market in here. So I'm just going to come down and look at the cycle periods that we're looking at right in here. So these are the minor cycles right there, and they're running around 9 weeks. This is the dominant cycle right over here, running around 27 weeks. And these are the minor thirds. You can see there was a minor third cycle right in here and a minor third cycle right there. So breaking this low right there, and that was negative right there, breaking that low, and then breaking this low right over here was also negative. And now once you begin this new minor cycle and it fails up in the resistance area right there, and it fails early in this cycle, we call that a left-hand translation. It's very negative when it fails early in the cycle because it has all that time period to fall, and you can see our projection over here. This is these are the fib extensions that you see here. This is the 61.8% fib extension that you can see labeled right over here where it has gotten down to. And then this is the 78.6, and this is the 100. When you see this color, it's our target zone that we're looking at. And that would, it's taken you down now past the 61.8%. And now, we've got all this white space over here, and there's room to rally. The sell zone comes in here. It begins somewhere around 38.45. So there could be a 200-point or more rally in the S&P 500 within this declining phase that it's now in. And then if were that to happen, it would be likely that it would get down here to about 35.35. That's where the target is right there. These lower targets right over here, which are 33.50, and then this major 61.8% at the bottom, right around 3,200. Those, I think, are going to come in later. So we look at this July period for the minor cycle right in here, falling down to about 3,500. This is 34.95. The top of that at the 78.6 is 35.35. So that's what we're looking for. A lot of, zigzagging here and getting down to 35.35. And then another attempted rally out over here in the summertime period, maybe rallying out into August and then getting wailed on again. These yellow areas that you see are the periods of risk, those yellow ovals, and they bring the largest decline. So looking at this, that largest decline is out there, coming out into that September time frame, and that's where we think you could see the market really get slammed. That's very reasonable, and you can see there's a red projection right over here that it gets down to that area around 3,200 in the S&P 500. An outside chance, if the market wanted to be much stronger, that it stops in this area of about 3,500. But that would be a pretty optimistic projection, in my opinion, looking at this, especially looking at the magnitude of the declines. S&P 500 so far has given up 24.4%. The fact that you had to wait for 20% to get it declared a bear market, I think, is one of the stupidest things that we ever hear from analysts. But that's what they like to do. In the meantime, the NASDAQ and the Russell had been down well over 30% for many, many weeks. It's officially they call it a bear market. But, look back in January, we said this was a bear market year, and I repeated that. So here is the projection, as you can see. And if you look out over here, this message right there, it's possible that the bear market low projection goes out to April of 2023. And I give that a pretty high possibility that you could get this bottom here in September, get a nice rebound. I mean, where the market puts on something like 15%, even 20% on the upside, and everybody thinks it's safe, and then a huge decline again after that out into April. If I look at this cycle right there and highlight it, that takes you out to April 2nd. That's another what we call complete harmonic family out there. And the fact that, the possibility of the bear market ending here in September, I think is a very low possibility when we look at that. So September, October, nested bottom in line with the monthly cycles that we look at, which is the beginning of the time frame for the monthly cycle to end that goes all the way out here into early 23. So there's going to be a lot of continued downside pressure from longer term patterns, and that is a problem. Here you can see in here where our reversal scout turned down. You can see that red arrow we put in there to show you. That was the point it said that there's a risk of hard selling, and you can see that's really happened, and the reversal scout is still pointing to the downside right there. So that's the S&P 500. Projections down to 3,500 right over here approximately, potentially down to 3,200 here, with the possible bear market going all the way out into April of 23. That's not something that anybody else is saying. Let's take a look at the NASDAQ NDX, and it's going to be a fairly similar story when we look here. We'll just bring this all down and bring you from the top here to those lows right there. Okay, so what we're looking at here is a very similar situation. As we see in here, the minor thirds on these cycles, the nested area where the biggest declines come into, the breakdown of the first minor third, the breakdown of the second minor third, the projection out over here. Now, you see this projection took you down to that 50% extension, which is what it hit today or this week. This actually is likely to extend further down. That next extension right over there is around 10,500, so we'll be actually wanting to lower it there, and that's kind of the bottom of that downward channel that it's been trading in, as you can see. So that is 10,500, and then the top of that fib extension right over there is just under 10,000. The bottom of it there is very near 9,000, and that area is that September-October period where all of the indexes sink in timing to come down to. So again, there is possibility that you're going to be able to get a rally in there, but it wouldn't last. You can see in here where the sell zones are. If the market is able to get a recovery, the bottom of that one is at around 11,700. So 550 points from here is where it begins to enter into that sell zone. That's where we would expect it to try to get to in a rebound. And everybody will be celebrating, but that is an opportunity to lighten up again if you haven't been able to do it. The top of that is around 12,200. So again, that range in this sell zone, 11,007 to 12,200. And that is our opinion, the best case that the market could get a rebound into. And then again, projecting down over here, 10,000. That's 10,600. That's 10,525. So that's the idea right there. You get that major 61.8% fib support area, that big thick green line, the 61.8% extension. Here you could see the reversal scout giving you this negative look. When you have a negative reversal scout and you hit in the weekly and you have short-term patterns, short-term momentum conditions in the shorter-term patterns, in the dailies, the 2 hours, the sum of the evidence says that the biggest impulses will be on the downside. So as long as this is pointing down, it's going to be a very negative condition. And we think that that might be able to get resolved a little bit over here in July and August, but then this other potential big decline right over there out into September, October, which is where these nested bottoms come in. So really what we're looking at is the S&P 500 and the NASDAQ in areas where there's a ton of risk. If relief rallies come just because they seem very oversold, it is likely that they will be followed by more severe drops. This is far from over. The actions by the central banks in the world is not only far from over, but in a lot of parts of the world just beginning. And that's really why the action by the Swiss National Bank shook the market up so much, because it really then highlights the fact that there is a lot of work to do in the world. The dollar is likely not going to be a safe haven anymore based on that. And if the Bank of Japan gets in line in here, which I think they're going to have to, then you're likely to see the dollar get some real big hits on the downside. All of that will set up some very good information and upside setups for the metals markets. And I want you to keep your eye out for some analysis that we're going to do on metals that will likely give you some very good opportunities on the upside. Still, we think that the picture for the metals markets is really a second half picture, and that all of this speculative money that has nowhere to go right now may very well go there, as well as finding periods where they buy up the stock market because it looks cheap. Well, it's far from cheap yet, and it was blown up to ridiculous levels for a long period of time, and there is a lot more to go to fix the problems that they created. Fixing the problems that they created. That is a look at the stock market and some other important mentions. I hope that you thought it was just fantastic information. Please do go to askSlim.com and subscribe. Share what you see and follow us. If you're new, become a free member, or go back and look at what Matt told you about level 1. It's practically free. It's a very, very low price for tons of information for both short-term index traders and longer-term traders too. If you're on YouTube, do subscribe to the channel, click that notification bell, like this video, give us a thumbs up, and watch member videos in the playlist, and you'll see some past shows in there that are very interesting. Twitter, follow us at askSlim, and write to Matt at askSlim.com for our specials, for membership info, and great questions you might have on our huge offerings of education and analysis. I want you to be so incredibly careful. It is so crazy out there. And I'm always wishing you great trading.